Hello, everyone. Thank you very much for joining us for this Nasdaq Dorsey Wright podcast on Wednesday, August 5th. My name is Ian Saunders, and joining us here today is Chuck Fuller. And Chuck, we're coming in today looking at these most broad domestic equity indices are in positive territory, at least at the time of this recording. Never going to say never, especially after the past few months. But at least at the time of this recording, looking at gains here across the board for the Dow, the Nasdaq, composite, and the S&P 500. And in taking a look at the S&P 500, chart that we've been continuing to monitor here, especially over the past few months, has been that 20-point chart of the S&P 500. You can navigate to that if you're following along on the platform by going over the left-hand side of the S&P 500 chart page and clicking on that 20-point under other scales. And in looking at that chart, we're seeing another X printed today at 3320. Looking at 3 consecutive buy signals here recently, and actually seeing 3 additional X's printed just over the last 3 days. I mean, we're only on the 3rd trading day here of August, and looking at 3 additional X's climbing back up towards that hot chart high of 3380 that we saw there in February. So definitely seeing some continued follow through to the upside as we head through the month of August here, Chuck.
Yeah, this rally off the bottom has been historic in a lot of ways. We actually celebrated I guess it was the 4-month birthday of the rally back in on July 23rd, and the market was up, I think, through that day about 45%. And to give a little context on that, the S&P 500, since it's been 500 stocks, which it turned to 500 stocks in, I think it was March of 1957. It has never been up 45% in 4 months, ever, since it's had 500 stocks in it. It did do it back in the 30s on a few occasions. Back then it was the S&P 90. So obviously a lot fewer stocks, it's easier to make that kind of rally. But even then, it only happened like, a handful of times back then. And typically it only happened off of, massive bottoms. It happened actually in 1932, which is kind of the granddaddy of all bottoms, right? 1932 was basically the bottom of the Great Depression. You had a 90% collapse in the market to get down to that bottom. And then, you had a massive rally off of that. And so just the fact that we're talking about this rally in those kinds of terms is really something. I mean, from my perspective, obviously I haven't lived that long to see, any of those crazy markets, but, I saw 2008 and 2009, and, probably 2009 was one of the greatest rallies that I've ever seen. And, when you look at the 2009 rally through the same amount of time, it was up about 31% versus 45% for this through 4 months. So it's really something I don't think, very many of us have seen in our lifetime. And, and probably rightly so. I think a lot of people are asking, well, okay, when's it going to stop, right? I mean, the headlines in the news are terrible. Keep hearing about, continued advancing of coronavirus cases and all these things. It's really hard to wrap your mind around the fact that we're back to within about 2% of all-time highs on the S&P. And then, and the Nasdaq is already hit new highs. So, it's like, how do you, it's a real hard thing, I think, for retail investors, especially to wrap their minds around, like, how can this be? How can the economy and the stock market diverge so much, or seem to diverge so much? And I think it's a valid question. But there's one thing that we've always said for, a number of years, and that is that the stock market loves to climb a wall of worry. And this might be the biggest wall of worry I've ever seen. So that's something to keep in mind. Now, in terms of, what could, cause this rally to turn around and go the other way, there are things that are out there that are, somewhat concerning, that we're looking at. One of the things I would mention is, PTSPX. For those of you who don't know what that is, it's a chart that we have on the site. It looks at the percentage of stocks on the S&P 500 that are on a point and figure positive trend. And so it tends to be a longer term indicator. Sometimes it can change multiple times per year depending on the volatility, but for the most part, you don't see a lot of changes happening in it. But here about maybe a little over a month ago, it reversed down into O's. And that's kind of a sign that something's going on behind the scenes. I think what you actually see going on is you've got the big stocks in the market, the FANGs, Microsoft, all that kind of stuff, obviously leading the market up. But underneath the surface, at least in the S&P, we're seeing more stocks giving or turning into negative trends than we are seeing new positive trends. And so, just seeing that reverse into O's by itself, probably isn't the worst thing to see happen. There's plenty of times where, reverses down and then reverses back up real quick. Is kind of a fake out. In this case, you've seen it come down 6 O's, and really, since it's done it, maybe we've seen a 2 to 3% pullback. Usually you see more than that if you see it come down this much. Doesn't mean that it has to in this case, but I think it's something to keep an eye on, as we keep going, because even though the markets continue to rally, we haven't really seen this thing get much closer to reversing back up. We're at I think that the actual reading was around 71.1. It has to get back up to 76 to reverse back up into X's. And 71.09 is up there. And so, that's kind of telling you that, okay, the index is moving up, but the stocks underneath, we're not seeing those new net positive trends that you would expect to see with the market acting like this. So that's kind of a divergence we're keeping an eye on. Again, it doesn't mean that the market has to roll over. It's kind of an early warning sign that something may be up. Another thing that I'm kind of thinking of too is, on the asset class group scores page. I don't know if you can go there for the video people, but when you look at that, fixed income is actually up fairly high there. As it is in Dolly too, although it looks like that may change today. In Dolly, the fixed income group. This is kind of a little bit more of a recent phenomenon. We've seen the all fixed income group kind of making its way up here in the last I don't know, maybe month and a half. It's got a group score of 4.19. Which is pretty high. I think it's actually the highest we've ever seen fixed income have on the system since we've been tracking it, going back to probably the early 2000s or so. So that's a little bit concerning. Now, we have an S&P 500 index group, and it's around 4.5, so it's still higher than fixed income, so that's good. But there's other other groups. Within the equity space that have fallen below fixed income. So we're kind of in a market, it seems, and a lot of commentators have made the same conclusion that if you're not in the big guys, there's not as much strength in everything else, and that it would be good to see some more strength in the broad market in general, to have a little bit more confidence in the rally. That being said, even though it seems irrational for the market to keep going up like this, especially with all the headlines and whatnot, the markets can stay irrational for a long time. I think we were talking about it, earlier. There's that famous, I guess it was Keynes quote, that kind of has to do with the opposite situation. If let's say you're holding on to a stock and it's doing terribly, and you think, it can't go down anymore. The Keynes quote was, the markets can stay irrational longer than you can stay solvent. So that it just kind of tells you that, you think it can't possibly go down anymore, but no, it can, because markets, can stay irrational for a while. And I think the same concept applies going up as well, right? The market can stay irrationally going up in price way longer than what you expect. Probably the the best example we have of that, going back in history would be the late 90s and into 2000 rally. The tons of people in, let's say, early 99, said, this is crazy. Get out, you just don't want to, you don't want to be touching stocks right now. And, sure enough, the market, kept rallying for another year to year and a half, before the actual top. And so you just got to be careful, making top calls like that, because it's tricky, right? I mean, the long-term bias of the market is up. You look at pretty much any kind of really long-term chart of the market, and you can't not conclude that, stocks go up over time. And so it makes top calling a lot trickier than calling bottoms, because of that. But I would think certainly at some point, it's not going to keep going up, 45%, every 4 months from here on out, right? Like, it's either going to slow down at some point, and obviously it's going to turn and move the other way at some point. But we don't know the magnitude of that. And after coming off of the coronavirus crash, earlier this year, I think there's probably a tendency for people to think that that's got to be what happens again. Kind of reminds me of 2008 in some ways, how it seemed like every correction that happened after 2008, everybody thought that, oh, here it comes again, right? Even though, it didn't materialize. Because that's what markets do. Markets are here to frustrate you. They're not here to do what you think that they're going to do. When everybody thinks that that the market's got to do something, typically it's going to do the opposite. And so I think that's a pretty good case for at least longer term, having this rally, continue, just because, that's probably the least expected thing for it to do.
Yeah, absolutely there, Chuck. And I mean, one thing that you and I were talking about there earlier as well, I mean, markets continuing to climb higher, as we mentioned at the beginning, is climbing back towards that all-time high that we reached there in February, at least for the case of the broader S&P. Some others, as you mentioned, went ahead and surpassed that high in the case of the Nasdaq. But in looking at from an individual perspective, an individual investor perspective, people seem to still be pretty bearish here moving forward. Seem to have a fair amount of cash on the sideline. And one way that we track that here on the platform is through some of the economic indicators that we have, one of which is going to be that the AAII bull-bear spread. And what we do with that for at least this chart is taking that on a 4-week moving average to kind of slow it down. And so for those listening in that might be unfamiliar with this particular indicator, essentially this is a survey that goes out weekly, and it comes out there each Thursday evening, and it's going to be printed here on the chart each Thursday evening. Potentially if there's a change, but it's looking at to identify those from an individual investor standpoint that are bullish on the market minus those that are bearish. So when you see the indicator here in negative, it means that there's more people that are bearish than bullish moving forward. And we saw this chart obviously move significantly lower in February. It was sitting up at 16% from a spread standpoint on this 4-week average, reversed lower in late January, early February, and fell all the way down to get down to negative 22% there in May. We then, with the rally that we saw at the bottom, the big rally, like you said, one of the biggest that we've seen here, did reverse back up, climbing back up to the zero threshold. Didn't quite get back that high. It got back up to negative 10% and then reversed down again towards the end of July there, and is currently sitting at a reading of negative 20 on the chart, saying that, I mean, there's still more people viewing the market moving forward that are bearish on things to come than there are that are bullish. And I mean, in looking at this here, Chuck, I mean, I know we have the 4-week one we're looking at here. We have the normal weekly spread, but you said you like to take a look at this one for that kind of longer term perspective, right?
Yeah, I tend to like this one, a little bit better. The other one's fine too. It's just, I'm just a little bit more of a longer term investor. And so, yeah, seeing this thing down at negative 20, I mean, for those following on YouTube, you can tell that, it doesn't get down here very often. It actually did back in May, got down to negative 22. But before that, you have to go back to 2016, if you remember that whole debacle. It kind of made it to negative 20 in very early 2016, like pretty close to that bottom. And then, I think the time before that, you have to go back to 2009, kind of as it was trying to make a bottom, at least in early, probably February or March of 2009. So it doesn't hit these levels very often. And it tends to hit them, obviously when retail investors are very bearish, which, that tends to be a contrarian signal. When you see them getting very bearish, tends to be bullish for the market. When you see them being very bullish, it tends to be bearish. So this is a good thing to see, for equity investors. I think it's a potential tailwind, for the market going forward. Like I said, seeing it down here at negative 20, you just don't see it that often. Actually, if you looked at the 1 week reading, and we don't have to look at that chart right now, but if you looked at the 1 week reading, last week it actually collapsed. Even though the market's been holding up well, the indexes are up and all that, but the number of, or the percentage of respondents, that are bullish went from, I think it was 28% down to 20%, in the 1 week reading last week, which, and typically you don't see it get any more, or any lower, I should say, in the bullish column, unless we're talking about, you're in the depths of a bear market. And, maybe you could have said that back in April, as we were coming off the rally, there's still kind of this idea that, well, maybe this is just a bear market rally that we're seeing. But now that we're back to within 2% of all-time highs, the Nasdaq is, obviously hit, new highs and all that. I think it's pretty tough to say that, this isn't, a bull market again. So that gives me some confidence, that, this is a tailwind versus a headwind.
And I mean, in looking at this as well, and looking at reversals on these charts, as you mentioned, they're looking at it from a more contrarian standpoint. We did run the numbers on this a little bit last week, and I mean, in looking back, since we had the origin of this chart back in 1987, there's been 33 times that the indicator has reversed down into a column of O's when it's in negative territory. So there's 33 times that it was already in negative territory on this indicator, and it reversed back down into a column of O's. And out of those 33 times, I mean, if you're looking a month forward from that, 26 of those occasions saw positive returns on a month basis, which led you to an average return of over 2% looking a month forward. Obviously, it's just expanded out further if you're looking at things 6 months forward. 27 of those times you're in positive territory for the 6 months after it reversed back down into O's, with an average return of almost 8%, it's at 7.8% there. So just, I mean, they had seen some numbers to back this up, but that definitely could be an interesting point to keep an eye on. It could definitely, for those following along that have the subscription there to the platform, an interesting chart to set an alert on for any kind of further movement from here. Another one here, Chuck, as you mentioned, kind of things to continue to look forward to, things getting a little bit frothy. A chart that we've been getting a fair amount of questions about, and one that tends to move around more quickly is the NYSE high-low indicator. And for those that might be more unfamiliar with it, this particular chart is measuring the percentage of stocks in the New York Stock Exchange that are making a new 52-week high divided by the percentage of stocks making a new high or low. And then we take essentially smooth that out via moving average. But basically, it's looking, okay, what stocks are making a new upside extreme relative to those making any extreme? And you generally like to see more stocks making that new upside extreme. And we've seen this indicator climb significantly, reaching levels that we don't see very often, down at 2% with the market decline there in March, and then shooting back up higher, all the way back up to a current reading of 92% with the double top formation that we see there. Reached it in June, and then now reached it again here in July. And Chuck, I know a lot of people that at least calling in and that we hear from tend to say, okay, this is in elevated territory. Does that mean it's too high? It's time to move out. Any kind of perspective or things that you're looking at on this indicator or others here moving forward?
Yeah, I mean, this is one of those things where, when it gets high, it's got one direction to go, right, which is back down. But what I will say is that when it gets really high, that tends to be more of a bullish indicator. And yeah, I would say 90% or higher is considered really high right now. If you can't see the chart, it's at 92 right now. So that I would actually say that that's a good sign, at least going forward. Like I said, doesn't mean we can't have a correction. I think probably even like a 10% correction right here would be perfectly healthy. But I think it suggests that longer term there's probably more upside than downside. Now, what would you look at to kind of tell you that, this is starting to turn over? I mean, there's the obvious, reversing into a column of O's and that kind of thing. One other thing that I like to kind of keep an eye on is if, looking at the kind of 70 line, if you see this, break below 70, let's say get to 68, but the market itself hasn't really broken down. That's usually a pretty interesting signal. I wouldn't say that, I would use it, exclusively by itself. If you see that in conjunction with some other things, like let's say this, the PTSBX still in O's and that kind of thing, I give it a little bit more credence. But you tend to see that kind of thing happen before the market really rolls over. In other words, you see the high-low kind of doing its thing first. So that's something to keep an eye on. But at the moment, we haven't seen anything like that. Obviously we're near 52-week highs. On the S&P. This thing's still in X's. It's up at high levels. Looking at the at least the one-day reading we're likely to get today. I'd have to go out and look and see where it is at this exact moment. But last time I looked, there was like 129 new highs today and 2 new lows. And so that's obviously a really high number when you do the math. So, I mean, this thing's not gonna reverse down unless we see some real bearishness in those numbers. So I think right now, we're fine. It's just kind of that PTSBX has me a little bit cautious. The fact that fixed income's moving up and asset class group scores has me a little cautious. But most other indicators, are looking pretty good. Like I said, with Dolly, there's a good chance that, and Dolly takes a very long-term perspective on the market. But Dolly is likely to move up. Domestic equities possibly could hit number 2 tomorrow if this rally kind of keeps up, and some of these other asset classes keep their rallies up as well. So far and away, I think that I have a bullish slant on where things are going right now. But just a few things to highlight as areas to be cautious with.
Yeah, very well. Well, wonderful there, Chuck. And I think there's no shortage of indicators for those that we provided here for those to continue to follow along. I think we've hit on most of those areas that we were looking to cover here this afternoon. Mm-hmm. For those of you following along here that do have a research subscription to the Nasdaq Dorsey Wright research platform, be sure to go in and set alerts on some of these charts that we're talking about. Most of the charts are going to have if it's a point and figure chart, it's one of these indicators, they're going to have a set activity alert button up at the top of the page. Something like Dolly will have a separate set alert button to be notified of any changes there. But that allows you to make sure you're not missing any of these things. Instead of coming back and saying, okay, this changed 2 weeks ago, I wish I would have made that or noticed that. Well, set an alert on that particular chart or area. Yes, it might clog up your inbox a little bit, depending on how many alerts you set. But at least you'll be notified there of any potential changes to any of these charts here moving forward. And at least some things to keep an eye on here as we head towards the end of the summer, which surprising to say, it doesn't feel like it should be the end of the summer here yet, Chuck, but we are nonetheless heading that way. So wonderful. Well, thank you very much, Chuck, for hopping on here with us this week. Thank you very much for everyone else listening in, and we look forward to having you back next week.
All right. Thank you, guys.